Okay, good evening everyone and welcome to our webinar. Can I just start with a quick little survey just to make sure everyone's hearing me okay and everyone can see my screen okay. You should have a little, either a tiny little box on the top right hand corner of your screen with a red arrow pointing to the left. Click on that if it's pointing to the left. If you've got quite a big control panel, you should have a little section there called questions, and it says enter a question for staff. Can I just have you typing in a yes if you can hear me okay, and alright, I can see a few of those comments coming through already. Looks like we haven't got any technical hitches, so that's all good. So let's get right into it. Okay, well, you've certainly turned up to the right place, because the subject of this evening's webinar is how to get a double NRAS payment on one property, odd as though this sounds. And what this is really all about, it's all about cash flow. That's what NRAS is really all about, and a double NRAS is even more about cash flow. So just a refresher that the main benefit of NRAS is the cash flow, because it can turn a negatively geared property into a neutral property, a cash flow neutral, and even a cash flow positive property, particularly where there's two NRAS incentives available. So with double NRAS payments, it's obviously got the potential to send your yield sky high. But there are a number of things to look out for. So that's what we're going to be talking about this evening. But before we begin, it only makes sense to talk about a double NRAS incentive if we are clear about what a single NRAS incentive looks like. So what we're going to do, you'll just need to stick around for a few more minutes if you're already extremely familiar with the National Rental Affordability Scheme, and to see how this getting a double NRAS payment works. So perhaps what we ought to do, if I can just have a show of hands, can everyone just type into the box on their screen perhaps the word very, if you're very familiar with NRAS, maybe if you own a property already, or perhaps type in the word not very if you're not, want a bit of an overview of NRAS before we get into the double NRAS. Okay, I'm getting a few veries, a few not veries. I'm just trying to. Okay, not very. Okay, thank you for typing that in. It seems that we're roughly 60-40. So what we'll do, we'll just have a quick bit of an overview, bit of a refresher course. This will, if you're very familiar, perhaps your own NRAS properties already, this will be a bit of a refresher. It won't take long. Just for 5 minutes, we'll go over it in basic detail, and we will go over it in a fairly high level of detail, because I actually ran a presentation a few weeks ago about NRAS, which we did record. So if anyone wants a link to that recording, just type that into the box on your screen. We'll pick that up later and we'll get you a copy of that in the next day or so. We can send you a link to that via email. So, quick overview of the National Rental Affordability Scheme, or NRAS as it's known. In very broad terms, you drop your rent by 20 or 25%. In return for that, you get $10,000 tax-free every year from the government for 10 years, and you rent it to what they call a key worker, which is just pretty much a middle income earner or a low to middle income earner who's employed. Again, we won't go into too much detail because I've covered this elsewhere, and we can get you a copy. It's not for bums, it's not for the unemployed or anything like that. It's kind of for middle Australia. So the main advantages I mentioned is the cash flows can be much better. Just a bit of a tangent on this. Why are the cash flows so important? The reason that cash flows are so important is because negative gearing is old news. Negative gearing only works when prices are going up rapidly, as we all got used to in the 80s, the 90s, early 2000s. But the world's changed now, hasn't it? For the foreseeable future, we're going to see most likely property price growth, not quite like this. We'll see property price growth, but not at quite such a steep curve. What that is a logarithmic scale of Australian property price growth from 1960 to 2006 or so. The logarithmic scale just means that it irons out the monthly ups and downs and just gives it in sort of shows you the overall trend more clearly. So in the old days, if you owned a property that cost you, say, $10,000 a year, this is sort of, let's say, pre-2008, if you owned a property that had a negative cash flow of about $10,000 a year, well, that was okay if you could sustain that, and if it was going to be going up at say about $30,000 or even $40,000 or even $50,000 a year. But now properties might go up. Let's say a property increases in value, say a $300,000 property increases at say $10,000 a year, which would be about 3% growth. Well, you really need that property to be cash flow neutral, because if you're going to lose $5,000 or $10,000 a year in negative cash flows to gain $10,000, it's really just not worth it. It's just a big waste of time. So NRAS is certainly one of the best ways to do that. So quick example on how the numbers look on NRAS. So a typical new NRAS property is say around $450,000 for say a new house, and that might typically rent for $450 a week. So you drop your rent by either 20 or 25%, and we'll use 25% to make it a bit more conservative in this example, and that's $113 a week of a decrease, which will leave you with $337. So in return you'll get, I'll use rough figures, about $10,000 a year from the government, and this is $193 per week. So straight away you appear to be about $80 a week better off. You're dropping 113 and you're picking up 193. Actually a little bit more complex than this for a couple of reasons. The expenses can be a little bit higher, but definitely not $80 a week higher. And secondly, the rent is assessable income, and NRAS payments are not. So you're giving up $113 a week of taxable income, and you're picking up $193 of tax-free income, which is even nicer. So for investors who are paying tax at 40 cents in the dollar or so, which is where most of our investors are, you're getting an extra $80 a week is actually like getting $133 a week. So this is effectively like taking the $450 rental income from the property and actually making it like getting $583 a week rent. So straight away you can see where the benefits are. That is the main benefit, and the other benefit, of course, is that there should always be plenty of tenants. You're dropping your rent by 25%. You're only charging, say, 75% of the market rent, so you're unlikely to ever have a shortage of tenants. So let's have a look at the things to look out for if you are going to consider an NRAS property. The first thing is that they can be harder to finance. But I must say this has been more true in the past than it is now. And you just really need to make sure of two things. Number one is you need to have a good mortgage broker who's familiar with NRAS. And the second thing is you need to have the right structure. And by this I mean you need something called a non-entity joint venture rather than a head lease. And we'll come to this and go through it more in a moment. So briefly, the things to look out for if you're going to be considering an NRAS property. Number one, you should make sure that it's not overpriced. It seems like a fairly self-evident point, I know, but what I really mean by this is some developers overprice their NRAS stock, and these are obviously the ones to avoid. So I won't cover this in too much more detail because I have elsewhere, but you just need to satisfy yourself somehow that you're not paying too much. The next thing, and this is going to sound like it's very, very obvious, but bear with me. It just needs to be a really good property, something that's going to get good long-term capital growth. And the reason I say this is because NRAS is just a way of holding a mainstream property in a mainstream location for 10 years or more, with all the costs being covered by the tenant and the taxman. So eventually, after 10 years or more, the NRAS benefits will eventually cease, and you're going to be left with a property, and you'll sell it, you'll keep it, you'll rent it out, you'll do whatever you want with it. So you just want it to be a good quality property. You don't want to be too focused, so focused on the NRAS benefits that you're focused on them rather than on the fact that you're really going to be making your money from the long-term capital gain. Next thing you need to look out for if you're investing in an NRAS property is that you can opt out of it. Like any property investment, this is long-term, so ideally you want to be planning to own it for 10 years or more than 10 years. You need to be able to sell your NRAS property if you want to before the 10 years is up, although you shouldn't plan to. Now previously this was a problem as the government stated that you needed to sell it to another NRAS investor, which obviously restricts your market, and is one of the reasons that the banks didn't like NRAS very much, and it's hard to finance. So if you're going to invest in NRAS, make sure you can opt out with a short notice period, say about 90 days, and you can sell your property on the open market if you need to. And the next thing that you need to watch out for is that you use a non-entity joint venture. And we're just going to pause while I have a little sip of water. Bear with me. Thank you. I'm doing all the talking. I just needed to hydrate myself. Okay, so there's two ways that your property manager will be a government approved NRAS property manager. There's two ways that they can strike the agreements with you. One is a head lease model, where they take a head lease over your property, and a head lease is often registered on the title. And what that means is that it can provide all sorts of problems for the investor, particularly again in relation to financing. So I mean it's still out there, it's still available, and I would avoid this model to ensure your agreements are what's called a non-entity joint venture. It sounds complicated. A joint venture is just obviously a joint venture between two parties, and a non-entity joint venture means you don't set up an entity. So when BHP goes and does a joint venture with Westpac to do some massive, corporate thing, they'll set up an entity to do a joint venture. So no entity is set up here. It's an agreement between you and your property manager. So all it does, in basic terms, it gives them the property for management, and it gives you, it's just a document, so it says you'll manage the property for me, much like a normal management agreement, and it also says you'll get the discounted rent and you'll get the government incentives. It's certainly a lot simpler as far as the lenders are concerned. So those are the things to look out for if you're going to invest in NRAS. But now to come to the juicy part of this webinar, how to get double NRAS payments on one property. Okay, now this is not widely known, but if a property complies with a certain number of criteria, you can get double NRAS payments. So this will be $20,000 a year, not the usual $10,000 per year. And again, we're talking rough numbers. So here are the criteria. Get your pen and paper ready if you've got a pen and paper. Firstly, the criteria. It goes without saying that the property needs to be NRAS compliant as though it was a single NRAS property. So this means a number of things. It means that the property needs to be new. It means that the property needs to be not lived in previously. It means it needs to be in an area that the government has determined there is a need. And it needs to be from a developer who has been approved to create a certain number of new dwellings for the NRAS market. And the rent needs to be discounted by 20% or 25%. That's the nuts and bolts of NRAS generally. And there's a few more trivial criteria associated with NRAS, but I won't go into it in great detail now. Because if you're looking at a property, it's either going to be NRAS compliant or NRAS eligible, I should say, or it won't be. And you'll know because whoever's selling it will tell you, or they'll advertise it as such. So specifically, to get 2 NRAS payments on one property, there needs to be a number of things. The first thing is there needs to be 2 separate lockable entrances so that a tenant can go into their property without needing to go through someone else's property. So, for instance, one of my family members has a granny flat out the back of their house which can only be accessed by going through their lounge room. That wouldn't work. It's not going to work at all. You have to go through someone else's living areas. So it needs to have its own lockable access. It needs to have a number of things of its own. It needs to have its own bathroom. It needs to have its own kitchen facilities. It needs to have its own bedroom. And it needs to have its own living space. It doesn't need to have its own laundry. A laundry can be shared. However, just a word of caution on that. Remember what I said before about good quality properties. You're really staying focused on buying a property for the long-term capital gain. Good quality properties tend to not share laundries. I remember my grandmother used to live in an apartment building where she had to go down 3 flights of stairs to use the coin-operated laundry. Maybe it was acceptable back in the early 70s, but not so much now. So it's okay for NRAS if you share a laundry that's compliant, and you'll still get your double NRAS benefits if all the other criteria are okay as well. But just be careful of the shared laundries. It can also share a garden and barbecue facilities and recreation facilities. So this is really there, I gather, as a criteria for maybe townhouse complexes and apartment complexes which tend to share those sorts of things. Okay, so that's the criteria. So what does this mean? What are your options if you're going to invest in one of these properties? Well, your options are a granny flat, or a duplex, or a dual key apartment. Those are the three things that may comply with those guidelines. So let's have a look at each of them in turn. Number one, granny flats. So granny flats can be a problem because in some areas you're not even allowed to build them, and in other areas, like in much of Queensland, and I'm not as familiar with where these rules might exist in other states, but I know in a lot of areas of Queensland you're not even allowed to rent out a granny flat to someone who's not a family member. So that renders the NRAS benefits totally useless. So you can't just certainly go adding a granny flat to an existing property and expecting, which is, because that's how granny flats usually get built, isn't it? And expect to get a double NRAS payment because the first one certainly was an existing property. So it just won't work. Duplexes. Let's have a look at duplexes. Duplexes are okay where they meet these conditions. The things to look out for with duplexes, you need to make sure of two things. Firstly, you need to make sure that the price is not too high. And I say that because in many good areas, duplexes can be around, say, $600,000 to $800,000 or more. And that's getting kind of generally a bit above where most people want to be investing, the price that most people want to be paying for an individual investment property. And the second thing is you need to make sure that they're in good areas. And the reason I say that is because you really want to just stay focused once again on getting good long-term capital growth. Because I know of a number that are being built in areas where you probably would rather not own an investment property, or rather you could probably find better capital growth performance in other areas than where you might be able to build an affordable duplex that is going to qualify for double NRAS payments. So the last option is dual key apartments. And you need to be careful with these as well, because dual key apartments are usually made in holiday resorts, in holiday locations, and they tend to be for short-term accommodation. So anything that's for short-term accommodation won't be suitable for NRAS. And also, often with dual key apartments, the most common configuration is a one-bedroom apartment on one side of it, and then a motel room on the other side that's accessible through a separate door. Now, I wouldn't buy one like that because a motel room is not really going to attract a good quality tenant, and it would be unlikely to qualify for NRAS anyway because motel rooms don't have kitchens and separate living areas, etc. However, there is one configuration that I would buy, and this is it. It's not so much a dual key apartment, it's more two apartments side by side, one being a two-bedroom apartment and one being a one-bedroom apartment, but together on one title. And the only place that I know of in Australia where these are being built are on the Sunshine Coast in a place called Maroochydore. So let me show you the plans and what they look like. So here's the plans of a two-bedroom unit. This is one side of it. So as you can see, I hope you can see that clearly on your screen, there's a bedroom there, there's a bedroom there, hopefully you can see my mouse moving. Two bedrooms with wardrobes and so forth. We've got a balcony, we've got a living area, dining area, kitchen, it's a galley style kitchen, we've got a laundry and bathroom and so forth. So here is a one-bedroom apartment popping up there at the bottom of your screen. Bedroom, kitchen, living, bathroom, all the normal sorts of things. So each one has its own separate entry, each one has its own bedroom, and each one has its own bathroom, because when you put the two properties together, that's what it is there. So the outline of that plan that you can now see on your screen, that is one piece of real estate. That's one title of one property. It's a 3-bedroom, 2-bathroom apartment. It's just a really clever configuration because it's got a wall down the middle of it. And if you look closely at the sort of bottom right-hand side of the screen there, it's got an area called lobby with door A and door B. So what happens is an NRAS tenant is going to, or this is eligible anyway, for 2 NRAS payments. So one tenant is going to be found for where it says door number B, so apartment B. So that's a one-bedroom apartment, right? That's going to be a single person, possibly a couple, most likely a single person who qualifies for NRAS. It just means that they're working, they're probably working locally, they're not earning a fortune, and they're going to take that unit there. So they're going to have a key for the front entry and for door B. There's going to be another tenant who's going to be found, or a couple of tenants, for the two-bedroom apartment. So that's most likely going to be a couple. It might be a couple with a young child. It might be a flat share situation, something along those lines, who would typically take a two-bedroom apartment. So those people are going to have a key for the front door and for door A, and those people are going to live there separately. So we have confirmed this with the NRAS approved property manager, who's going to be doing the compliance, and what they have told us is that this is approved. What that means is that they will issue 2 compliance certificates on that. They're going to do the NRAS, put an NRAS tenant into one and issue the one bedroom side and issue you with a compliance certificate, and put another NRAS tenant into the other side and issue you with another compliance certificate. So what you do is you take those 2 compliance certificates at the end of the year to the Australian Taxation Office when you do your tax return, and what do you know, you get 2 lots of the NRAS payments of roughly $10,000 a year. So let's have a look at how the configuration of this affects the cash flows on this property. So I'm just going to jump over here to a little PDF document. This is a cash flow forecast. I know that looks too small for you to see on the screen at the moment. I'm going to zoom in just a second. This has been prepared by some chartered accountants by the name of Vincent. It hasn't been prepared by us, and nor has it been prepared by the developer of these properties. So what it is, it's basically a profit and loss statement for the average investor. It's got income, rental income, minus expenses, taking account of depreciation, and then taking account of the NRAS benefits. In this case, the 2 NRAS benefits. Now, here's the interesting and the really cool part. Let me just zoom in on this a bit for you. What I want to show you is this figure here. I don't know if you can see on your screen where the little hand, from which is my mouse, is moving, but at the bottom of that first left-hand column, above the red line, what that says, it says the after-tax cash flow surplus is $13,904. Or looking at another way, the figure below that, if you can't read that, it says $267 per week. So this is for a typical investor. They've modeled this on a typical investor who's earning, paying tax at 40 cents in the dollar, which means they've got a taxable income above $80,000. Each individual investor might be a little bit different from that. If people who are earning more, the cash flow surplus might be higher. People who are earning less, it might be a bit less as well. So this, but in rough terms, for a typical investor, this is how much you'll pocket after tax. So this will keep going for 10 years, and you will then therefore conservatively make $130,000 in positive cash flow over the 10 years that the NRAS program runs. Look, I'm being very conservative and saying $130,000 there. I'll show you why. I'm just going to jump back to this spreadsheet. Now let me just zoom out a little bit and just explain something. Okay, these columns, the left-hand column is year 1, then there's year 2, year 3, year 4, year 5, and year 10. The last column is year 10, and let me see if I can zoom in on that last column, the positive cash flow on that last column. What it reads is $25,801. So by year 10, the positive cash flows are due to be about $25,000, other things being equal. So the reason for that is because the rent is indexed to the CPI every year, as is the NRAS benefits. So if we were to average that out a bit, you'll find the average between 13 and 25,000. You'll find it will be a lot more than 130,000. In positive cash flow. So, but let's just say for the moment, let's keep it conservative and say you make $130,000 in positive cash flow over the 10 years that the NRAS program runs. And after that, 10 years later, what you'll end up with is a nice 3-bedroom apartment on the Sunshine Coast of Queensland with a very useful configuration. So the possibilities then, what's going to happen then? Well, the possibilities in 10 years' time are, well, you could just rent it out as a normal 3-bedroom apartment. On the normal rental market, NRAS will be finished by then, let's say, and you'll just get your normal market rent. And obviously there's 10 years for the inflation to take its effect on the rent, so it'll be a lot higher than it is now. Better still, you could get more rent by renting it out separately in the same way that it will have been for the last 10 years, because you'll be able to get more rent by renting it out separately as a 2-bedroom unit on one side and a 1-bedroom unit on the other side. Your other options, you could sell it, you could live in it, you could live in half of it, you could holiday in it, you could holiday in half of it and rent out the other half. You can basically do whatever you like with it. It's just that there are more possibilities with a configuration like this than there is with a regular 3-bedroom apartment, because it is very flexible. And these properties are selling off the plan now, and they're going to be built over the next period of about 2 years. So when I talk about 10 years time, what I'm really talking about is 12 years time from now, taking account of the 2 years it'll take to build. So 2 years to build, 10 years under the NRAS program, that'll take us to the end of 2025. So it will actually be early in the year 2026 before you actually need to decide what to do with this property. Now, it seems a very long time away, doesn't it? And it certainly is, 2026. Certainly a long time to run a property out of cash flow surplus. It's kind of like, the way I view this, it's kind of like buying a property in 2026 into the future, you know, a long way from now, 12 years from now, but back at today's price, at the 2013 price, because for that intervening time, it won't actually cost you anything to own. In fact, as we've seen, it's going to line your pockets with a very tidy, very high positive cash flow in that meantime. So by then, during that time, you might have paid it down. I don't see why you couldn't use that $130,000 in positive cash flow to apply it to the loan that you might take out now in order to purchase this property. So it could pay itself down. Or better still, what you could do is you could use that surplus cash flow to pay down the non-deductible debt on your own home, which should have a big advantage from a tax point of view, and you perhaps should discuss that with your accountant. So of course I don't know about your individual tax circumstances or family circumstances, of course, but we do know a fair bit about what's happening on the Sunshine Coast and what the Sunshine Coast will look like by 2026, because we know about a whole lot of planned and committed infrastructure projects that are underway now. Or looking at it the other way, what sort of capital growth can you expect between now and 2026? Well, let's just have a look at a few of the factors, because I'm sure you'll find this very interesting. What is driving the demand for the rent and the demand on the property values over the next few years between now and 2026? Well, firstly, let's just have a look at a bit of a map here. There's a map of the Sunshine Coast. See the map of Australia down the bottom left-hand corner? That's where we are, just about an hour's drive north of Brisbane. So this is that section of coast. You might be familiar with it if you've been here on holidays or something like that, or if you're from this part of Queensland. So Maroochydore, there it is there, and that's where the development is, just where that blue arrow is pointing now. Now, if we go just about 10 minutes drive, let's say 15 minutes in terrible traffic, but around about 10 minutes drive to the south, there's currently a big chunk of vacant land there where there are 2 hospitals being built side by side. One is called the Sunshine Coast University Hospital, and there's an artist impression of it coming up on your screen now. This is going to be, would you believe, the 6th biggest teaching hospital in the entire world. It's the first new public hospital to be built in Australia since the early 1990s, in about 20 years. And right next door on the same site is currently being built a private hospital operated by the Ramsay Group, who a doctor friend of mine on the weekend told me was a very good hospital operator. These 2 hospitals are going to create around 4,000 permanent jobs. And that's not including the 2,000 construction jobs which it'll take to build these things, which will be a huge stimulus to the regional economy. There's going to be 15,000 people expected to visit this hospital every year. And as you can see from this master plan of the precinct, those 2 hospitals, which are absolutely huge game changers in themselves, or even just one of them is, it's only a small part of a much larger story. So the hospital site is on the top of your screen. You can see a purple section. You should be able to read it says hospital site there. And that's, if you divide that in two, that's where the two hospitals are going. There's the town centre, which is the two green oval shapes a little bit below that to the right. There's a town centre, a health innovation park, an academic centre, and these are going to employ more than 5,000 people as they're being built, and another 5,000 in permanent jobs on completion. Now here's the interesting bit for me. Overnight, just one of these facilities, just one of those hospitals, the Sunshine Coast University Hospital, is going to become the single largest employer on the whole of the Sunshine Coast. And the Sunshine Coast is a city of 400,000 people. It's the 11th biggest city in Australia. So overnight becomes the largest single employer. And that doesn't include the other hospital. It doesn't include the adjacent facilities, which together are going to employ more than that number of people again. On the other, so this is just an absolutely game-changing thing. One of the most massive pieces of infrastructure anywhere in the country. Let's go back to this map here. There we are again in Maroochydore, where the blue line is pointing now. So on the other side of this development, about 5 minutes drive to the north, we've got another blue arrow pointing there to the Sunshine Coast Airport. So what's likely to happen by 2026 is that the Sunshine Coast Airport is going to be going through, or have gone through, a big expansion that is currently in its environmental impact statement stage. What this means is I can't promise, or nor can anyone, that it 100% is going to go ahead. We can promise that with the university hospital and the other hospital because they're under construction now. But it just means that it's likely, and there's an EIS happening right now. So what will probably happen is that by 2026 there'll be international flights. There'll have been they've tagged about $419 million that's earmarked for this project. So it's likely that the whole area will be receiving a big lift for more tourism, more business travel, more freight. There's a new terminal to be built. There's a green bit on your screen coming up now, which is the existing airport. I'm just drawing a red circle around it there. So that's the existing Sunshine Coast Airport, if you've ever flown in there. And this blue area here, it's a new runway and a new terminal building and a whole lot of new facilities. The other thing that this should facilitate, which will have a big effect on the local regional economy in the Sunshine Coast, is that already on the Sunshine Coast there's quite a few flights. There's some flights being operated to fly miners into the remote parts of Queensland. So they live on the Sunshine Coast, they do their shifts, whatever their shifts might be, 4 days on, 4 days off, that sort of thing, and they come home and live on the Sunshine Coast. So all those big dollars that they earn in the mines, they bring back and spend them on the Sunshine Coast. And this is likely to be much increased as those airport facilities increase. Now, 2,700 jobs are expected to be created at permanent jobs at that new airport facility, and almost that number again. Sorry, almost that number just in construction, so about 5,000 all up. Now, let's have a look a bit closer to where this development actually is. So there we are again, and within walking distance of this development, just a few minutes drive away, there's an aerial photograph of Maroochydore coming up now. So this red circle that's being drawn now, that's called Sunshine Plaza. So that's the largest shopping centre by a long way on the Sunshine Coast. It's the largest shopping centre north of Brisbane, and that's due to be expanded next year, 2014. It's already huge, and it's going to be 50% bigger than it currently is. It's going to create in itself 1,350 jobs, cost $350 million, and increase that shopping centre already by 50%. But in addition to that, I should tell you that the development that we're talking about, where these dual key double NRAS properties are available, are just off the bottom left-hand corner of the screen there. You can see a little creek there, and they're just basically on a site that's adjacent to the creek there on the left-hand corner. Now, have a look at the golf course. Have a look where that blue arrow is pointing. That's the Maroochy Town Centre. The current Maroochydore Town Centre. Now, if you've been there, it's a bit tight, it's a bit tired, and it needs something done to it. But gee, are they going to do something to it? check out this golf course here. See that golf course? That's called the Horton Park Golf Course. And what the council have done, they've purchased that golf course and they're going to rip it up and they're going to build a new golf course on the edge of town for the golfers, about 8 kilometres away. But what they're going to do on what is currently the golf course is to build an entire new town centre. So as you can imagine, on something the size of a golf course, you could fit a heck of a lot of town centre. What they're doing is planning to build 150,000 square metres of commercial space, 65,000 square metres of new retail space. There's going to be an arts centre, a transit, a plaza is planned, a new library, a public amphitheatre, a new civic plaza, and the whole area is going to get a big freshen up. The whole thing is worth about $4 billion, and the first buildings are expected on site around 2016 to 2018. And why are we so interested in all this job creation? I know I go on a lot about all these jobs being created, and that is because it creates demand for real estate. It has to. Prices of real estate, as we know, like anything else, are ultimately determined by supply and demand. And all these jobs being created means more demand. More demand for rental properties, more demand from buyers. So more demand for rental properties will ultimately drive up the rents, and more people buying will obviously put upwards pressure on values and should increase the values. So what we're looking at with something like this, the reason that we're so interested in the job creation is because all of those factors and all of those jobs being created are basically more jobs than are being created in most other parts of Australia. So therefore the capital growth should be higher. So now, in 2013, there is an opportunity to get into the property market now, before all this job creating and wealth creating infrastructure gets built. And according to independent property analyst Michael Matusik, and there's a photo of him there, basically he's done some analysis of it, and he counts up 22,000 permanent jobs being created just in this immediate vicinity across those projects that I mentioned. So there we have it. So you've attended the webinar this evening to learn how to get a double NRAS benefit on a property, and these opportunities are as rare as hen's teeth because we've been looking for something like this for a long time. And the reason, well, it's probably why you've never heard of it before, because they are very, very rare. So here we've got an opportunity where these double NRAS payments can create a huge positive cash flow, around 13,900 or up to 13,900 a year, or $267 per week positive cash flow right in the middle of all this infrastructure development happening. There's only one problem if you might be interested in these, and that is that we've only got 11 of them available as of right now. They are priced between rough figures 525 and 550,000. And if that is too much for your investment budget, within the same development, we've got other properties that are priced at about half this amount, which is 267,500, from 267 up to about 300. Now, what that will get you is a one-bedroom property. Being a one-bedroom apartment, of course, there's no way that it can qualify possibly for a double NRAS benefit, but it will qualify for a single NRAS payment, and because the price is very, very affordable, the $10,000 divides quite well over that purchase price. So what that means is the same analysis based on the same assumptions by the same firm of chartered accountants comes up with a positive cash flow of around $6,600 per year on a property that's priced between 267 and 300,000 roughly. So that's about $127 a week based on the same modelling. So that would be a great option for people who aren't able to stretch their purchase budget quite enough to get hold of that double NRAS benefit, and for people particularly wanting to spend less than 300,000, because we don't see a lot of investment opportunities under 300,000 anymore. There's certainly nothing wrong with them. I say that because they're just really well priced. Well, I say that because whenever I see new apartments being advertised, they always advertise at a from price, and that from price is often sort of a low starting point, often in the 300s, low 300s, something like that. And when I see a low, from price, I think, oh, that'll be the studio, it won't have a car park, it'll be less than 50 square meters, it'll be hard to borrow, no one will want to live in it, this sort of thing. So that's not the case here. For between 267 and just over 300,000, you get a decent one-bedroom apartment above the 50 square metre lending threshold. The banks are happy with it. It's got a car park. It's got a proper kitchen. So it's just really affordable. And we've got a limited number of these available as well. So I should just tell you that what we've done is we launched this project just over a week ago. So far, 17 of them have sold. So that just shows you how much, well, what other investors think of this deal, really. So if you're interested in getting yourself something that's got a double NRAS payment and you want those positive cash flows on something very affordable with, and really we'd have to say masses and masses of capital growth potential, upside potential with all those jobs being created, those 22,000 odd jobs being created, then this is the only thing that I know of that kind of ticks all those boxes. So if you're in a position to consider this opportunity now and you'd like to talk to us about it, then what you could do is you could do one of a couple of things. You could go to this website here and put your details in here. I'm going to show you what this website looks like. In fact, what I'm going to do, I'm just now you should see in your chat box a little link that's come up. That is that website there, to save you having to write that down or to type it in and you might make a typo or something. So there's a link on the right hand side of your screen. If you click it, it's going to take you to a page that looks like that, and what you should do if you're interested is just complete those details, put your details in there, and then we'll be in touch with you very soon. What you can do is you can, I'm just going to go to this page. There it is there. You can tell us when you'd like us to contact you, tomorrow or some other time, or even right now if you're very interested, and fill in your details and your contact details, of course, and we will let you know. If it's some other time, just please specify when that is, over the weekend or whatever. Just be aware that obviously you know, they will continue to sell, so the people who we speak to first who are interested will have the best opportunity to pick from what the best available ones are. I'm just going to go back to this previous page now, because that's got our phone number on there, and if you prefer to give us a call if you're particularly interested, then please just pick up the phone and call that number that's on your screen. It's 3137 9494. That's a Brisbane number, so that's got an 07 in front of it. So that's the opportunity that we've got for you. If you're not in the market now and you just wanted to find out about this business about double NRAS properties, then that's obviously absolutely fine. We hope you found this webinar helpful and informative. And I'm just going to have a look in the question box now to see if I can see any questions coming through. You're welcome to type in any question. I've got a question here. How do we change our managing agent? Okay. Look, we're gonna take that question. We're going to take that question. Look, I promise to answer every question. Type your questions into the question box. We may answer them now, and we may answer them individually, one-on-one. Is the rent guaranteed for the 10 years, meaning it will be rented for the duration? That's a great question. The rent is not guaranteed. The rent is discounted. So I'm going to ask you to think about this question. If you were a tenant, and let's just pick on the Sunshine Coast for argument's sake, you've got the choice between renting a normal property at 100% of the market rent, or you could rent a property that's brand new in a resort with wonderful facilities, swimming pool and all sorts of things in a great area next to the massive shopping centre for only 75% of the market rent. Which one are you going to choose? That's your rental guarantee. Okay, clearly, you know, I mean, even if there was a vacancy problem, which there's not in this area, and there's unlikely to be, you know, obviously there should never be any sort of vacancy. Perhaps, you know, you might get a week in between tenants, but there'll never be any sort of vacancy problem you'd expect with the rents being discounted by 25%. Okay, I've got an individual question about someone's retirement, so that we'll take that one-on-one. How easy to get insurance and at what cost? Yes, yes, you should insure it. In fact, you need to insure it, and it will be a few $100s a year depending on the insurance company. Okay, there's quite a lot of the questions appear to be coming through, which we should probably answer one-on-one. There's another one, a question about the guarantee. Has construction started? And when will it be fully built? The construction has not started. Well, yes, the construction has started. Stage 1 is already built, and what we can do is we can take you there if you want to visit, and you can walk through one of the apartments. However, they're all sold, of course, and double NRAS opportunities are not available in the first stage. So what we can do is show you models of what will be built, so that second stage, which is what's available for sale off the plan now, is being built. It will start to be built around the middle of this year, and then it will complete roughly on the end of next year. Is the property in a known flood area? Well, what an excellent question, Greg. That one is, given what we've all been seeing on our televisions. The property is built above the flood mark, above the council designated flood areas. It is close to a kind of a man-made lake that comes off a creek called Cornmeal Creek, and it's been, as you know, absolutely bucketing down there on the Sunshine Coast over the weekend and since then, and it's been that creek has not even risen a bit. So what we'll do, we'll send you some photos. My colleague here, Brian, is just suggesting that I bring up some photos, which is probably a good idea. But what we'll do, we'll send you those photos. If you just go to that website and put your details in fact, what that's going to do, it'll take you straight to a page where, firstly, you're going to see a presentation from that property analyst that we talked about before, Michael Matusik, and it's also going to enable you to go straight to a brochure where you can see all the photos and stuff. Somebody else is asking, how do they get started? Do you need any deposit? Well, yes, you do. It's an off-the-plan purchase, and so what happens with off-the-plan purchases is you put down a 10% deposit. So what happens initially is you put down, if you looked at this and you decided that it was for you, you put down an initial deposit of $5,000, and that will get the contracts sent to you, and then you sign up the contracts, and then you top up that deposit to 10%, taking off, of course, the $5,000 that you've already put in. So if you were to buy one of those double NRAS properties, let's say they're between $525,000 and $550,000, so you're going to be putting in a deposit of, say, around $52,000 to $55,000 in rough terms. And those single NRAS properties, let's say you get a one-bedroom for, say, $285,000, you're going to be putting in a total deposit across two payments of around, say, $28,500 in that example. So that's the 10%, and that is payable by way of cash, and it's payable now, like over the next month or so, as you 14 days after you sign the contract. So if you were to go ahead with one now, it will be available, it will be payable in about a month's time, let's say. And somebody's asking a good question about a $2,000 documentation and compliance fee. Look, we're going to there's actually a fee that's in there that is being a couple of things. Noel is asking a question about a $2,000 fee that came up with on the spreadsheet here. Now, look, that's an interesting one. There it is there, if you can see it on my screen in the first year, $2,000 compliance fee. What the chartered accountants have done, they've overstated this considerably. They've overstated the expenses, rather. They haven't overstated the rental income. They've certainly overstated the council and water rates at $4,000. And they've overstated the compliance and the documentation fee. That really should be $720. There's an initial payment in the first year of $2,000, $2,200 actually, but the developer is they've agreed to pay that for us for our clients, and so that won't really be just rest assured. Look, I didn't really want to sort of promote this to everyone, but the expenses are overstated. Therefore, the bottom line, the $13,000, $13,900 surplus should be a little bit higher. But yeah, you will pay about $700 in compliance fees every year, and that is to get it compliant. And while we're on the subject of that, the property, you will pay a property management fee as well, and you can see that there at 11%, and that's 3% higher than what you would pay for a normal property, but it's 3% higher on something that's discounted by 25%. So 11% of the rent would say if it comes to $40, then 8% of the market rent would come to about $39. So it's about $1 a week difference. So in dollar terms, you're paying exactly the same amount, slightly higher in percentage terms. But basically, we haven't dwelt on that because it's all taken into account in the bottom line. The bottom line being that almost $14,000 positive cash flow. Okay, somebody's asking, how long will you be able to purchase NRAS properties for? I heard they'll only be available for a few more years. That's true. What's the government initially, when they came up with this program in 2008, what they did was they had a budget of 50,000 houses to be built for the NRAS program, and they've allocated about 40,000 NRAS licenses to developers so far. They're doing it in stages, and what that means is that doesn't mean 40,000 properties have been built, because not all that number will have been sold yet, because, for instance, these ones that are available now would still be within that allocation. So what that means is when that 50,000 is taken up, then there will be no more NRAS properties available unless the government decides to extend it. So I hope that's answered the question. Someone asking what's the holding deposit, and that's $5,000, as I mentioned before. Richard, thank you. That's a nice comment. Alan, I'll take your question another day. Who selects the tenant? The property manager selects the tenant, in consultation with you as per a normal property manager. What are the body corporate fees? There are the body corporate fees on your screen there for one of the most expensive 3-bedroom units, $4,474 a year in the first year, as has been budgeted. Once again, sounds a little bit high. Well, not high. It sounds normal, taken into account already with the bottom line of the $13,000. This $13,000 cash flow surplus. Okay, there's some great questions coming in. How do these properties compare to similar properties in the area? That's a great question. There's very little new property being built, new apartments being built on the Sunshine Coast. They compare extremely well because what I'd suggest really I'll refer you to someone else who can answer that question a lot better than me, and that is to Michael Matusik. If you put your details into that form that looks like this, by going to the website that's linked on your screen, what you'll do, you'll go straight to a presentation from Michael Matusik, as I've mentioned, and what he does is a bit of analysis on that, and I'll leave it up to him to say what he says, but he's got something to say about what sort of a percentage these are cheaper than other comparable properties in the region, and I think you'll be pleasantly surprised when you see that. Also, really, there's a point to be made here about these properties not being sort of holiday properties as you get on some other areas of the Sunshine Coast. They're really for the local market of the local workers working across all those thousands of jobs being created, as well as the jobs that are already existing in the shopping centre and all the infrastructure close by. They're certainly not holiday units, and what you might find elsewhere is holiday units, which are kind of a different market. They're a discretionary market, and they tend to not perform as well. I'll tell you another thing as well. This is a mixed-use development, and in a mixed-use development, what that means is there's coffee shops on the ground floor, and it also means that there is at least one commercial building that's already been built. I'll just show you some. I'll just show you some images. So we can. Okay, so let me just zoom this out a little bit. That's a picture of the stage 1. This is one of the reports that we're going to send you if you just leave your details in the form there. Let me just scroll down here a bit and see if we can find a photo in this brochure of the commercial precinct. But basically, on this site there is already a. Oh, here we go. Here's a site plan. I don't know if you can see this. Okay. So there's already a site plan. So immediately next door to this building, there's already a commercial building that's been built. It's called Emporia. It's all part of the same development. The tenants in there are KPMG, Parkinson's Brinkhoff, I think they're called, a engineering firm, and another firm whose name I can't remember. And so they're in there. So there's jobs right here on the site, as well as just across that road there. There's all the shopping centre and infrastructure there. So anyway, what I was getting to was, again, Michael Matusik, the fellow who's produced this report, has done some research on mixed-use sites. A mixed-use site is things that have commercial office space and retail space and stuff like this has, and has got some analysis and some data that indicates that mixed-use developments tend to perform about 2% better in terms of capital growth than non-mixed use. So that's an interesting one. Thank you for asking that question. Sorry, just looking at some of the other questions here. For the dual key apartment, okay. Okay, we've got a question from Mike about lenders' mortgage insurance, and he's mentioning that they're not the mortgage insurers aren't crazy about these properties. What LVR can we expect? Look, we've spoken to our brokers. I did mention that you need to get a broker who is experienced with this. We're told that there's no problem getting 80% at all on these, and whether you can get more or not, we don't know. You'd need to just put in talk to a broker, and we'll refer you to one who's very experienced with this. But look, if you can do 80%, that would be ideal. We normally recommend people do 80% to avoid mortgage insurance. Got a question about do we get quality tenants? And well, look, the tenants that you get, there's a little bit of a misunderstanding, I guess, about NRAS amongst some people. The tenants need to be employed. That's a basic criteria. There should be plenty of them to select from. There is an upper ceiling of the income that those tenants can earn because it's for sort of low to middle income earners. So really the reason that the government brought in NRAS was because there's a whole lot of Australians, let's call them middle income Australians, who can't afford the normal rental market. They're police officers and nurses and teachers and people who work in shops and retail and people who work in childcare centres and who care for the elderly and waiters in restaurants and waitresses and things like that. So those are the sorts of people that you're going to get as your tenants. There's going to be heaps of them to choose from because they're being offered a property at a 25% discount to the market rent. So the quality of them is good. They're not rich people, but they're certainly not undesirables, let's say. Is there a minimum number of units in a complex before NRAS applies? No, there's not. This developer's got a certain number of these, roughly half that can, a bit more than half that can be that can be NRAS. They had something similar in the first stage. A lot of those licenses were NRAS licenses were not taken up. And the reason for that was because a lot of people who bought were owner occupiers. So no, look, if one person, I know of another building in Brisbane which was muted to be a sort of a, have a number of NRAS opportunities in it, and it's got one. So no, you don't need a minimum number. What sort of, okay, we're getting that question about the deposit again from someone else, and from somebody else. What is the stamp duty in Queensland? Look, it's a formula. It's a bit less than 3.5%. It's a sliding scale, depends on the purchase price. You'll find it on the Office of Fair Trading Queensland website, but it's a bit less than 3.5% because on the, so we'll work it out for you. Just give us a shout maybe tomorrow. What are there other incentives? Other incentives, a government incentive other than NRAS? Not really, no. Do we anticipate, here's a good question from, I think it's Kerry, do we anticipate more of these double NRAS properties in other areas in the future? No, is the answer to that. We've heard about them and gone looking for them, and they are, as I said earlier, as rare as hen's teeth. And sometimes, if we do come up with something else, I expect it might be a duplex, but to get an affordable duplex, we're going to have to go to an area that might not perform as well in capital growth as this. You never know. We might come up with something, but unlikely. Is the 13,900 tax after cash flow the total for both the 1 bedroom and the 2 bedroom? Yes, it is. Thank you for your question. Okay, look, there's what percentage of the whole complex is NRAS properties? Up to 55 keys out of 83 apartments. So an NRAS dual key is 2 keys. So it's going to be something like up to possibly as much as half, or a bit less than half. But as I mentioned before, if stage 1's anything to go by, it'll be considerably less than that, and this developer will have some spare NRAS licenses for their next development, whatever that might be. Question about the first homeowners grant in conjunction with NRAS. We're going to have to take that question another time. Is there a sinking fund? Yes, there will be amongst those body corporate fees. Someone's asking about again the quality of the tenants. I guess I answered that question before. Talk to your property manager. Just make sure that you've got a hand in selecting the best. Are they suitable for self-managed super funds? Yes, they are. You want to check that with your financial advisor about, I need to say that whenever you talk about self-managed super funds, but that there's nothing in the self-managed super fund rules that says that these won't comply. Okay, look, thank you everyone for your questions. It's been a wonderful webinar. I hope you've enjoyed it. I will just go back to that page there, so give us a call on that number. We're here this evening. We will stay here as long as you like, answering your questions. We may or may not be able to take everyone's calls this evening. Otherwise, please just go to that link. Just click on that link that you should be able to see in your chat box. Copy that link down there. Go to this page here. Put in your first name, last name, phone number and email, your state, and when you want us to call you, and we'll be in touch. And you'll be able to then click on that and see a whole lot. We'll get you instantly a whole lot more detail. All right, so look, we'll sign off this webinar now. Thanks so much for attending, and have a great rest of the evening, everyone. Okay, bye for now.